talk us through market activity. Market down in the session, but we are seeing a lot of upward momentum on the session on the NSE 20. What are you making of this?
I think, the sort of activity that we've seen over the last couple of days can be explained really by portfolio manager flows. We're seeing a lot of portfolio rebalancing right now with local fund managers moving cash out of fixed income and out of other alternative investments and back into equities, which is a converse of what we saw towards the latter part of last year. So because of that rising demand, again, foreign investors have also been active in the market. That has helped push the index up. We've seen a lot of momentum. There was a bit of worry about whether we'd see a correction once a lot of these stocks started trading ex-div. That has not materialized, and we're seeing still significant upside on the index from here on.
A whole lot of upside on the index from here on. Now looking at the shilling, pretty range bound between levels of 83 and 83.50 against the dollar. Has been stuck in this region for a number of weeks now. Could we perhaps see the shilling continuing to trade in such regions? We have seen the central bank coming in and buying up a lot of liquidity in the market.
Yeah, I think, if you look at what the central bank have been doing in terms of their most recent interventions and actions, both on the forex side and again in the money markets, so the open market operations, it does seem to suggest that they're comfortable with the shilling at current levels. So anything between, say, 82.50, 83.50, they'd be willing to take that sort of, level for the Kenya shilling going forward. We do not see a bias to weakness. At this point in time, we believe that the central bank has continued to build its reserves, and with the $600 million loan expected to come in sometime this month, that would also further boost reserves, raising again import cover with oil prices again declining. So again, that is supportive of the Kenya shilling at current levels. We don't really think it's time to go long the dollar right now, and I think that will affect how the forex market moves from here on. So, current levels, we expect this to be sustained. Might see some marginal movements, maybe one shilling 50 cents either side. But yeah, we retain our stable outlook for the shilling.
Let's take a look at those T-bill rates continuing to fall below that psychological level of 15%. We do have some issues later on this week. What kind of demand are you seeing coming through there, and what type of rates do you perhaps see coming through?
I think you have to look at two things. Number one thing the central bank did was reduce the amount that they've been looking to get from the market, particularly in the treasury bill side, the much shorter end of the yield curve. And basically what that has done is again push demand up. Initially they were looking for about 8 billion every week. Now they're only doing half of that, which is about 4. And we've seen bid to cover ratios shoot up on both the 91 and 182-day treasury bills. So, with that sort of demand, again, you expect bid shading by a lot of these players. Banks are still gaining deposits, a bit jittery about lending to consumers, so they have to park that money somewhere, and the obvious avenue again would be government paper. So, in as far as demand is concerned, I think we're probably looking at seeing negative real returns on the treasury bills, which would be, different from what we've been seeing right now. Our focus for the end of the month is about 12.90 for the 91-day treasury bill, which again mirrors what's going on the demand side. So, negative real returns probably by the end of this month, certainly next month.
Now looking at that interest rate decision left at 18%, number of analysts saying that the central bank is perhaps behind the curve. What did you make of that decision? Was it the right decision to make for the central bank at this time?
We put out a note sometime in March, and what we said at that particular point in time was that we expected the central bank would be overestimating the probability of revived inflation this particular year. They keep on drumming about the risks that are inherent in the oil price actually going up on account of geopolitical risk. We've seen the rains come through, and we're expecting lower food prices in coming months. So, as far as the economy is concerned, we're seeing, quite a bit of decline in consumer spending. If you look at new motor vehicle sales, those are down, based on levels we've seen historically at this point in time. we're seeing investment capex by farms is down, machinery and capital equipment imports again taking a hit because of the high interest rates. So we think, if you put all this into perspective, then the likely sort of scenario you expect is for GDP growth to be lower than has been forecast. We have a number of about 4.45%, which is a downgrade from what we're expecting in 4.6%. Now, putting all this into perspective, decline in housing starts, we think the central bank is again playing it a bit too cautious. We'd have expected to see rates coming down at this particular MPC meeting, but we also expect that perhaps they're looking at the currency and thinking, what sort of effect would a rate cut have on the Kenya shilling from this point in time. So our outlook again is that the probability of a rate cut increases the next month. Once the reserves are built up, once again that loan I mentioned, which should probably boost reserves to about 4.7 billion, about 4.4 months import cover, that would be supportive of the Kenya shilling. And I think that once we actually see that inflow come in, we're probably going to see the central bank try to ease by 150 basis points from current levels.
Well, thank you so much, Evans. That's where we have to leave it now.